Good morning, everyone, and welcome to the Daily Hunt for Multibaggers on this Wednesday, March 11th, 2026. We've got some interesting data to sift through today, based on our analysis from yesterday, March 10th.
That's right. Our AI models flagged quite a few distinct stocks, and we saw a significant amount of social media chatter. The sentiment, I'd say, is quite mixed out there, showing both pockets of strong optimism and some serious underlying concerns.
Definitely. It's shaping up to be a hunt with both promising growth plays and some riskier propositions, as always.
So where do we start today, Ethan?
Well, let's kick things off with Robinhood markets, or Hood. Our data shows a real surge of bullish sentiment, Brooke. Users are talking about it being massively mispriced, with some even throwing out an aggressive price target of $250. The company's vision to become a financial super app could really drive future growth, and their current net profit margin of over 42% is pretty solid. It's been a bit of a mixed bag for us in the past, bouncing between buy and speculative gamble, but the community optimism is palpable.
Optimism is one thing, Ethan, but the KPIs tell a different story. The PE ratio is sitting at a rather high 38.31, suggesting a lot of future growth is already priced in. And then there's the debt-to-equity ratio, a concerning 136.04. That's a lot of leverage. Let's not forget the significant insider selling we've seen, with over 3.3 million net shares sold in the last 6 months. Even analysts are pulling back their price targets a bit, even with a buy rating. It's highly volatile, too, with a beta of 2.479. For me, that's a lot of risk without the current revenue growth rate of 26.5% to fully back it up.
I hear you, Brooke. The future growth is speculative, but the community really believes in it.
Indeed. However, when we weigh the high valuation, the debt, and the insider activity against that future potential, my analysis still points to caution. For Robinhood markets, Hood, our AI-generated insight for today is stay away.
All right, let's pivot to Oracle, or ORC. They just reported strong Q3 earnings, you know? The news highlights surging AI and cloud growth, plus a massive $553 billion backlog. The stock even rallied after hours, showing that immediate market reaction was quite positive. Given this, I think it has the potential to improve its free cash flow and reduce debt in the long term. We've often classified Oracle as a stay away in the past, but these numbers could be a game changer.
Well, Ethan, while the income statement looks good, the balance sheet is frankly alarming. Our data confirms a debt-to-equity ratio of over 432. User comments are pointing out negative free cash flow and stressing that this PE ratio of 28 doesn't compensate for the immense financial risk. Analysts have even lowered price targets, even while acknowledging cloud strength. A company relying so heavily on debt, even with promising growth, is concerning. Until that debt is managed and free cash flow turns consistently positive, the risk remains substantial.
It's a classic growth versus risk dilemma, but that backlog, Brooke, could fuel years of revenue.
It could, but it doesn't change the current financial structure. For Oracle, ORC, given the high debt and free cash flow concerns that users highlighted, our market commentary is to stay away.
Okay, moving on to a perennial favorite for growth investors, Nvidia, or NVDA. The data shows it leading a significant tech rebound. Users are calling it one of the most interesting names to watch. Their revenue growth is an exceptional 73.2%, and the net profit margin is an incredible 55.6%. With their deepening role in AI infrastructure, this company is firing on all cylinders. We've had it as a buy quite a bit recently, and the momentum feels strong.
There's no denying NVIDIA's incredible performance and leadership in AI, Ethan. The growth and profit margins are truly outstanding. However, we have to look at the price-to-earnings ratio, which is high at 37.71. That means a lot of future growth is already priced in the current stock price. While the potential is there, the stock's high beta of 2.375 also signals significant volatility. It's a fantastic company, but that valuation means expectations are sky high, and there's little room for error.
Right. But if anyone can meet those expectations, it's Nvidia, given its market position.
True, but it still warrants a closer look. For Nvidia, NVDA, considering its strong fundamentals but elevated valuation, our AI-generated insight is to investigate as cautious buy. Investigate as buy? None. Investigate as cautious buy? Nvidia Corporation, NVDA. Investigate as speculative gamble? Robinhood Markets, Hood.
Well, that's our deep dive for today, folks. A big thank you for tuning in to the Daily Hunt for Multibaggers. Before we sign off, remember this. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Do your homework. We'll catch you next time on The Daily Hunt.